But this is why you shouldn't put all of your eggs in one basket. Okay. If the bank is only covering $250,000 and you have more than $250,000, why would you put all of your money in and not be insured? Why would you put all of your money in one bank and it not be insured? Okay. Um, we're not talking big companies now. Big companies with, making a lot of money with a lot of employees, yeah, it makes sense for you to have all of your money in the bank because you got to meet payroll, you got to pay bills, and you want to be able to move money in between accounts and transfer that money without having issues. But for non-business people, you have to think about diversification as far as your money and putting it in the bank, because remember, you're putting your money in the bank and the bank is then loaning your money out. So $250,000, having more than that at one bank may not be the wise thing to do. But at the same time, why do we have $250,000 sitting in a checking account instead of that money making money for you? Welcome to another episode of Becoming with Angelina Watkins, and I'm your host, Angelina, your queen of becoming, and I am here to help you become who you need to be so that you can win at love, life, and money. So I want to welcome you. Thank you so much for tuning in, and if this is your first time, thank you for joining us. I really appreciate it. Don't forget to hit that subscribe button and that notification bell so that you don't miss another episode, because I am here every Thursday dropping the knowledge to help you become who you need to be so you can do what you're supposed to do, so you can live the abundant life that you want to live. So we talk about everything that you need to know in order to live that prosperous life, emotionally, spiritually, and financially. So today we're going to talk about money, and we're going to get into talking about the collapse of Silicon Valley Bank. Why did this bank collapse, and what does that mean to you and our economy? So that's what we're going to get into today. Now, as you go through this, I'd like to hear from you. Don't forget to leave me some comments below. Are you fearful of what's been happening? Are you fearful in the economy? How is this impacting you? Because we want to have a conversation, because there's a lot of people living in fear right now of the economy and what's happening, and they are scared of what has happened with these banks collapse. And so we're going to talk about this a little bit, but don't forget to leave me a comment below and tell me, what do you think? What do you think about the bank collapsing, and how is that, and what fear or no fear has it put inside of you? All right, so let's talk about this. Silicon Valley, back at the beginning of March, it collapsed, and there's two reasons why the bank collapsed. We're dealing with diversification and bank run. And so I want to talk about both of those, and then we'll kind of talk about what this means to our economy with this bank collapse. So let's talk about diversification first, okay? So you have Silicon Valley. They were the 16th largest bank, and they highly specialize in financing and banking for tech companies. They really dealt with a lot of startup companies. They had a lot of technology firms that were banking with them, as well as some of the tech executives. And so the tech sector has been kind of having a hard time, and they started falling, and they've been having these mass layoffs, right? And so we deal with a diversification issue when it came to Silicon Valley, because a lot of this is they dealt with a lot of tech. And if the tech industry is going down, that means that their money is going down. And if their money is going down, what does that mean for Silicon Valley? If most of your customers are tech customers. And so we're dealing with diversification of specializing in one sector, and that sector in the industry is not doing as well now, versus a bank that might be dealing with several sectors, that if this sector goes down and their money goes down, their deposits and what have you, it's not really going to affect me because I have a diversification of customers. So diversification of customers kind of hurt Silicon Valley a little bit. The other thing was diversification in their investments. They had quite a bit of money invested into long-term US Treasury bonds, as well as mortgage-backed securities. And so when we're dealing with long-term treasury bonds, we're talking about bonds that are 10 years or more for maturity. And for those of you who don't understand what is a bond is when you actually loan money. A US Treasury bond is when you're loaning money to the US government, right? And then they're going to pay you interest, and then they're going to pay you back your principal at the end. Well, if we are investing in bonds, that means that we've actually loaned this money out to the US Treasury. And so one of the things that you need to understand is that when you deposit your money into the bank is loaning your money out to others, and they're also investing that money. And so let's think about that for just a minute. The fact that you put your money in the bank, and your deposit, you expect your money, you think your money is sitting there, but your money's not sitting there. The bank actually takes your money and they loan it out in auto loans, mortgage loans, personal loans, different types of loans where they're charging high interest rates of maybe 8%, 10%, 20%, depending on what the loan is. And you're only getting back probably no percentage if it's sitting in a checking account, and less than 1% if it's sitting in some type of savings account. If it's in maybe a money market account, you might be getting a little bit more. But just think about the fact that they're taking your money, loaning it out at like 8%, 10%, 20%, and only giving you pennies on the dollar, right? So you have to know that the bank takes the money that in the deposits that are made, and they use that to make them money. And they make their money by investing it and or loaning it out. And so part of their lending or investments was in US Treasury bonds that are more than 10 years old. And so in this economy, you have to know that with inflation and the rising of rates, of interest rates, that will cause bond values to go down. So while at the time that they invested in the bonds, it was probably a good thing and a good return on the investment, but interest rates rising will make bond values go down, because now whatever that interest rate was at the time that they had gotten the bond, let's just say it was 3% or 4% or maybe even 5%. Now with interest rates going up at maybe 6% or 7%, well, that bond is not valuable. Not if I can get a bond for a higher interest rate. I don't want that bond. And so now what you have is that they had to sell bonds in order to cover withdrawals. But the bond value is not there. So that means that they had to short sell, what we call short sell the bonds. They had to sell the bonds for less than what they're valued for, which leads us into the second reason why they fell, which were bank runs. They are now having to raise capital to be able to pay for these large withdrawals that's happening. And the raising of capital is spread like wildfire on social media that, oh my God, Silicon Bank has to raise capital. They don't have any money, which forced a lot of people to run to the bank and withdraw their money. And if they're withdrawing their money, then that's leaving Silicon Bank with nothing. And so then now the bank collapses, right? And so it was on March 6th that they announced that they were raising this capital. And now people are trying to go and get their money because they think their money is not going to be there. And then that also adds now to the collapse of the bank. And so what do you need to know? This is what you need to know. You need to know that the FDIC, which is the Federal Deposits Insurance Corporation, covers deposits up to $250,000. So if you put $250,000 in the federal government is going to cover that $250,000 deposit. And President Biden has announced that they're going to cover the deposits beyond that $250,000. So anyone who had their money in the bank with Silicon Valley, the government is saying that we're going to cover you, we're going to make you whole, and we're going to make sure that you get back your money. But this is why you shouldn't put all of your eggs in one basket, okay? If the bank is only covering $250,000 and you have more than $250,000, why would you put all of your money in and not be insured? Why would you put all of your money in one bank and it not be insured? Okay. We're not talking big companies now. big companies with, making a lot of money with a lot of employees, yeah, it makes sense for you to have all of your money in the bank because you got to meet payroll, you got to pay bills, and you want to be able to move money in between accounts and transfer that money without having issues. But for non-business people, you have to think about diversification as far as your money and putting it in the bank, because remember, you're putting your money in the bank and the bank is then loaning your money out. So $250,000, having more than that at one bank may not be the wise thing to do. But at the same time, why do we have $250,000 sitting in a checking account instead of that money making money for you? So when we talk about diversification, where else can you be putting your money that, one, it'll be safe, and two, it's going to be making you a better return on your money than it is sitting in a bank getting less than 1% on a savings and nothing on your checking. So we have to think about diversification, okay? Now, the government is not going to, one of the things that you have to know is the government is not always going to do a bailout. This is going to be a case-by-case basis. So don't think that, I can put $250,000 in the bank because if the bank collapses, the government's going to come along and I'm going to get all my money back. That's not going to necessarily be true. Okay, I think this is a very special circumstances because we've never known them to come in and do any more than $250,000. I would not bank on putting all of my money in one account that's more than $250,000 at one bank and thinking that if something happens, the government is going to give me my money back. Please know that the law and the regulation for the FDIC is that they only cover deposits up to $250,000 per bank. Okay, so diversify your investments. Okay, that's what you need to know. Diversify your investments. We had the Silicon Valley Bank. All of their investments are, a lot of their work was in the tech sector. Just like that, you shouldn't have all of your investments in one sector. You should diversify your investments and diversify how you're holding your money. And you want to make sure that you have safe investments. It's not smart for you to have deposits tied up in long-term, all of your money tied up in long-term investments. So you want to be able to make sure that you have different sectors that you invest in, that you have some short-term investments, some long-term investments. You have money that you can be able to quickly turn into cash versus money that's going to sit somewhere long-term. Okay? So make sure that you're diversifying your investments. Now, what does this mean to the economy? What does this mean to us in the economy? Signature Bank also collapsed. Now, they collapsed because we had people running in fear. When they heard about Silicon Valley, they all of a sudden they're running and they're making large deposit withdrawals. And it caused the Signature Bank to plummet. But this doesn't mean that the economy is going to plummet and we're going to fall. We're dealing with fear here. And just like the stock market, when we get wind like, oh my God, the stock market is going down and everybody runs to go sell all of their stocks. Okay, that's the same thing we're dealing with here with the bank, is that people are running now to go get their money out of the bank out of fear. And we have to know that it's not, all of the banks are not going to fail. What you're probably going to see is banks tightening up a little bit more on lending out money. I mean, it already got a little tight with the rising of the interest rates, but you'll probably find that they're going to tighten it up just a little bit more in lending out money. What this means is that some of our startup companies, it's going to be maybe harder for you to get that startup capital that you need, with banks coming down and tightening up their reins on lending out money. Outside of the bank collapse, we're still dealing with the tech industry going down and laying off people. But what you have to know is that doesn't mean that the whole economy is going down. Everyone has their turn. Everyone has their turn in not doing well, or not doing well in a certain economy. Our economy goes through cycles. You have to know we go through cycles. We go up and we go down. Back in 2008, it was real estate. A few years after that, we were dealing with the industry, the auto industry bailout, where the auto industry was in trouble. And so we just have different sectors at different times that may have issues, but that doesn't mean that they're going to always have issues. Like the economy, it goes up and it goes down. and everybody has their turn. So just know that for you in this economy, what you need to do is make sure that you are building wealth. You are setting yourself up to recession proof your income. Okay, that no matter what market we're in, whether the market is down, whether the market is up, whether the economy is down, whether the economy is up, you have your wealth to where it can sustain you, whether you're up and down. So you want to make sure that you are diversifying your investments, okay, and that you are recession proofing your income. Now, if you want to know more about that, my book is now for sale on Amazon. I will put the link down in the description. And so you'll want to make sure that you are building wealth. It's called Path to Prosperity, the 17 Secrets to Building Wealth that you can start today. Now, I hope you've gotten something out of this. Let me know. Leave some comments below. Let me know if you enjoyed the show. Let me know if this was helpful. Let me know if it made sense. And let me know, are you scared? Are you scared? Are you fearful of the economy and where we are right now? I'd love to hear from you and know where you are. Okay? Now, where you are is not where you have to be. Your past does not define you. You define you. So heal, transform, and pursue you.